I think gold is a must-own asset, and I wish I didn't have to say that. Gold has served its purpose for at least 1,000 years, but likely longer, as being both a medium of exchange and a store of value. Gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. We've already talked about why people need to be concerned about that, because there's a guarantee that your purchasing power in fiat savings instruments deteriorates. With gold, at least you have a chance. And it has evidenced itself as a superior store of value for at least 1,000 years. Importantly, too,
Rick Rule argues that gold has re-entered the global financial system not just as a hedge, but as a form of long-term protection against the steady erosion of purchasing power. In his view, relentless money creation, rising government debt, and periodic liquidity injections have created a monetary backdrop where holding fiat savings guarantees gradual loss. Gold, by contrast, has preserved value for centuries precisely during periods when confidence in paper currencies weakens. Rule emphasizes that this is not about short-term price speculation, but about owning an asset that has repeatedly proven its ability to function as both a store of value and a form of monetary insurance when traditional systems come under stress. Looking ahead, Rule sees technology restoring gold's historical role as money. While physical gold has traditionally carried high transaction and storage costs, tokenization and digital deposit receipts are lowering those barriers dramatically. As transaction costs fall from several percentage points to fractions of a percent, gold becomes increasingly usable not just as savings, but as a medium of exchange. Rule suggests this shift could allow gold to function simultaneously as money and wealth preservation once again, a role it has not played meaningfully since the 19th century. In that context, he views gold ownership not as optional, but as a rational response to the structural realities of modern monetary policy. From an investment perspective, Rule also highlights royalty and streaming companies as a superior way to gain exposure to precious metals. Unlike mining operators, these businesses are not burdened by rising capital costs, operational risks, or inflation-driven overruns. Their revenues flow directly from production, making their margins structurally stronger. Rule notes that while many investors assume growth in this sector has peaked, the opposite may be true. With massive capital requirements looming across the global mining industry, particularly in copper, royalty and streaming companies are well positioned to acquire gold and silver byproduct streams at attractive valuations, potentially driving long-term growth that the broader market has yet to fully price in. Now, we present the clips from Rick's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
I think gold is a must-own asset, and I wish I didn't have to say that. Gold has served its purpose for at least 1,000 years, but likely longer, as being both a medium of exchange and a store of value. Gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. We've already talked about why people need to be concerned about that, because there's a guarantee that your purchasing power in fiat savings instruments deteriorates. With gold, at least you have a chance. And it has evidenced itself as a superior store of value for at least 1,000 years. Importantly, too, with the advent of technology, gold is becoming at once a store of value and a medium of exchange. And let me explain. When you, Daryl, go to buy physical gold at a dealer, whether or not it's in the state of Washington or not, you're probably paying a 3% premium on the buy side and a 3% premium on the sell side. In other words, your transaction cost is 6%. But increasingly, with the availability of digital coins representing gold deposit receipts at places like Tether and elsewhere, you will be able to do that same transactions for fractions of a percent, which means that you will again be able to use gold as money. You'll be able to go to Starbucks and buy a cup of coffee in gold. And Starbucks will be able to aggregate all of those fractional payments and, if they wish, surrender those coins for physical gold, which means that gold increasingly in the future will be at once a medium of exchange and a store of value, which is another reason why I think you have to own gold. On the one hand, to defend yourself, and on the other hand, as a recognition of the fact that gold will once again fulfill a role in society that it hasn't fulfilled since the 1800s, which is to say, simultaneously a medium of exchange and a store of value. It's very difficult for me to understand why a rational human being wouldn't have a substantial gold portfolio. One needs to familiarize yourself with the Tether product. My understanding is that the Tether product is not 100% backed by physical gold or silver, although I don't need to know that to be the case. If you're willing to own a gold surrogate as opposed to physical gold, if you want to lower your transaction cost and not have to be worried about physical storage, there is always disclosure of conflict of interest. The Sprott product. The Sprott product is 100% backed by physical. Institutional holders can redeem their trust for physical units, which reduces and often eliminates the arbitrage. In other words, makes the underlying security track the gold and silver price much more efficiently. And the transaction costs on the New York Stock Exchange are de minimis. So the first level of risk reduction, if you want to obviate the transaction cost, the storage cost, and the insurance cost, is probably the Sprott product. I am, as I say, unfamiliar with all of the specifics around the Tether product. I am unsure as to whether the Tether stablecoin is 100% backed by physical gold or silver, and whether or not one can surrender the XAUT for physical gold or silver. If that feature isn't present, either Tether will add that feature or somebody else will create a coin that will allow you to do that. Mm-hmm. Probably the most secure form of storage would be in a vault that was owned by a publicly traded company, so that you could assure yourself that the balance sheet and the income statement of the vault owner precluded you from experiencing the risk of the vault owner stealing your gold or silver. At Battle Bank, my bank, we have insisted that our own gold and our customers' gold be stored at Brinks, precisely because we don't want them to store the gold at home, where they could experience personal security risks, but also because my memory of the 1970s was that a lot of people trusted their gold and silver to storage facilities that then either folded or stole the metal. And I don't want to experience that risk. A third thing that you could do, and I've done this in the past, is store your physical gold and silver in a safe deposit box in a depository institution where you have access to it. From a practical point of view, what I found, at least, is that it's inconvenient. In my particular case, I stored the gold in Vancouver, and I would buy it at one bank where it was cheaper and walk it down the street and deposit it in another bank, which was at once dangerous and inconvenient. Gold is heavy. And I paid the commission, both going and coming. So although I still have a fairly small amount of physical gold held in a safe deposit box, a legacy of my own laziness, I have more physical gold stored at Brinks, but I have the overwhelming proportion of my gold, silver, platinum, and palladium holdings represented by depository receipts in the form of the Sprott physical products.
Recent political debates around stimulus checks, tariffs, and efficiency reforms are reinforcing a deeper concern about the long-term credibility of the dollar. The argument being made is that governments continue to promise restraint while simultaneously expanding spending, effectively trying to satisfy every constituency at once. Cash handouts framed as relief are, in reality, recycled taxpayer money, used as a political tool rather than a solution to structural problems. Efforts to reduce waste or rebalance trade sound serious on paper, but history shows that entrenched political systems rarely deliver lasting reductions in government size or obligations. Instead, spending is redirected, not reduced, leaving deficits, debt, and monetary expansion to quietly do the real work of adjustment through inflation. Looking forward, the implication is not a sudden collapse, but a prolonged erosion of purchasing power. The dollar's decline is expected to play out in absolute terms rather than through dramatic losses against other currencies, as most major economies face the same political incentives and fiscal pressures. Unfunded liabilities, aging populations, and voter demand for benefits create a setup where outright default is politically impossible, making gradual debasement the more likely path. This is why Rick Rule has repeatedly emphasized that inflation is not an accident but a policy outcome, one that disproportionately harms younger and unborn generations. In that environment, real assets become less about speculation and more about self-defense, as individuals are forced to protect themselves from decisions made far beyond their control.
The Czechs are bribing us with our own money. Let's be straight. What they do is they steal it out of our paycheck, and then they give us back 10% of it, signed by Trump. It's amazing that so many of the American electorate are stupid enough that they can be bribed with their own money. Doge is predictable. The Department of Government Efficiency was toothless. I'm old enough to remember, Daryl, the Reagan Revolution. Ronald Reagan came into office with an overwhelming mandate. He didn't win by an eyelash like Trump did. He had an overwhelming mandate to reduce the size of government. And he employed a guy named David Stockman, who you met at my conference in Boca Raton last year, to head the Office of Management and Budget. And despite the popular will of American citizens in 1980, the professional political class derailed the Reagan Revolution in 6 months. They made mincemeat of the Trump administration, who was never in favor of lower spending anyway. He wanted to divert resources from circumstances that benefited other people's constituency to circumstances that benefited his constituency. He was never about less government. He was always about different government. And it's always that way. Elections were described by, if my memory serves me well, Ambrose Bierce. It may have been H.L. Mencken. Elections were described as advanced auctions of stolen property. The process doesn't change. The high bid changes. It might be Biden. It might be Bush. It might be Obama. It might be Trump. But the truth is that everywhere and always, they seek to bribe you with your own money. If they benefit you accidentally. You need to look after yourself. And Daryl, in an advanced auction, the loser is always the young person or the unborn person. The deterioration in the purchasing power of the U.S. dollar will impact nobody as seriously as the unborn. My generation, the baby boomers, voted ourselves all kinds of cool benefits and services, but we forgot to pay for them. The consequence of that is that the net present value of unfunded entitlement liabilities in the United States exceeds $120 trillion. Trillion dollars. And it gets worse. That's why I say that the deterioration in the purchasing value of the U.S. dollar is an inevitability. We have two choices, Daryl, as a consequence of politics. One, we can be honest like the Argentines and default. Or two, we can do what America did in the 1970s, which is default on the installment plan. Keep the nominal value of the promises while inflating away the net present value. I think we choose door B. I've lived through it before. I know how it happens. I know how it ends. And I'm doomed to live through it again. Forewarned is forearmed. Hopefully, over the course of the next year, you and I in our discussions will tell people how to arm themselves so as not to be taken advantage of by the situation, and hopefully, in fact, to take advantage of it. If I was to be charitable, Daryl, I would say it's well-intentioned fraud. But I think it's worse than that. I think about myself as an example. You know, I've been investing in natural resources and critical metals, now in energy, for 50 years. I don't think that Trump is a better steward of my investment capital than I do. I don't think I need him as a money manager. I think if you took the 16 elements that compose the rare earths on the periodic table as an example, that Mr. Trump couldn't spell any of them. So the idea that he's going to invest my money for me is something that I object to rather strenuously. In terms of the dearth of investment in the United States, I'm not a politician, I'm not an economist, and I could solve the problem beginning tomorrow. Literally beginning tomorrow. Let me explain. The U.S. tax code is consumption friendly, not investment friendly. If you and I were to build a mill in socialist Sweden, the tilt-up concrete building that we would build to house the mill, we would expense against our taxes in year one. In China, we would expense that in year one. In Russia, we would expense that in year one. And in the United States, we amortize it over 33 years. Guess where you build the factory? I don't want Trump to give me money. I want him to leave me with my own money. We could reestablish the American industrial might in 10 years if we reformed the tax code to make it once again investment friendly as opposed to consumption friendly. What we have decided to do in the United States is to steal money from people who generate wealth to distribute it to people who consume wealth. All admirable, something that curries the favor of the people who consume more than they generate, but not the way that you establish industrial capacity. You raise workers' wages, and real wages have been in decline in the United States for 35 years. You raise workers' wages by educating them and allowing them to employ more capital. Think about the difference between somebody who operates a front-end loader and somebody who digs ditches with a pick and a shovel. The guy who operates the front-end loader operates a $750,000 piece of equipment, but he replaces 100 or 150 pick and shovel workers. It is cheaper to employ the machine operator at $40 an hour than it is to employ 100 pick and shovel workers at $7 an hour. You restore America's industrial capacity and competitiveness, and you restore America's wage rates by changing the tax system in a way that aids capital formation and allows American industry to allow its employees to employ more capital. It's as simple as that. Politically, that's extremely unpopular. What we would rather do is eat our cake than have our cake. The consequence of that is that we're coming into a period of time where cake becomes very, very scarce.
Looking ahead to 2026, many analysts expect gold to continue its transition from a defensive hedge into a core monetary asset. The dominant view is that the next phase will be driven less by headline interest rate moves and more by structural demand that does not respond to price in the usual way. Central banks are expected to remain steady buyers. Institutional allocations are projected to rise gradually, and confidence in fiat currencies is likely to weaken as debt servicing costs grow. In this environment, gold is increasingly seen as a neutral reserve asset rather than a speculative trade, which is why forecasts cluster around a sustained move into significantly higher territory rather than a brief spike. Silver, in contrast, is widely viewed as the higher volatility expression of the same trend. Analysts point to a tightening physical market, rising industrial consumption, and years of underinvestment in new supply as conditions that could amplify price moves once momentum builds. While gold is expected to climb in a more controlled fashion, silver is seen as prone to sharp revaluations if investment demand overlaps with industrial shortages. The prevailing outlook suggests that if monetary pressure intensifies and real assets reprice across the board, silver could outperform on a percentage basis, turning what has long been a lagging market into one of the most dynamic stories of the cycle. Share your thoughts in the comment section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.